I've done a lot on gold. I know it's just what people are trading at the moment, so I'm going to focus on it now. And it's really important. Gold is basically a risk management trade for most. Like I said on my previous streams, you've had a massive, massive gap from 2011, where you start to come out of the financial crisis, into 2012. And then for literally 10 years, well, 8 years, 9 years, you don't get a new high. Okay, now until COVID comes around, you then get high, everyone panics, and they invest in gold. And then you come away. People think, you know what, COVID wasn't as bad, that's it. Then it shoots up again because people start to get worried about war. Then it comes up again, okay, because they're worried about financial crisis and the implosion of the global economy. And now it's up immediately on renewed war fears. Okay, so people are getting really scared. When you get fear in the market, okay, if you read fear gauges, fear and greed gauges, you'll notice that gold starts to fly up when people get afraid. That is what's happening now. So you have to think to yourself, okay, well, if people are getting worried about what's happening in the world and they're flooding into gold, what do I really want to do about it? Okay, how do I want to treat this? I know it's likely the market will pull up. I know that. Okay, but the problem with that is it's already priced in. You've seen it go up. It's too late to buy, right? Now, remember what I said a minute ago. I'm not saying I don't think it will keep going up. I'm just saying that I'm looking for probability over time. I know in the long run, if I buy highs, I'll lose money. That is a fact. Okay, in the very long run, if you only buy at the top, you are just buying into where people are selling. Okay, and remember I said if your stochastic oscillator or your RSI is up and it's gone up considerably and it keeps going up, it doesn't mean it can't keep going up. It just, again, is about probability. Okay, if you're buying into a high, you are less probable naturally over time to make money. It's the same no matter what you're trading. If you're off your computer and buying and selling anything else in the real world, it's the same. People who run businesses don't buy things for more and sell them for less. Okay, they don't. So what you have at the moment is a situation where it's ideal to drop your risk significantly. Now, I said for anyone on these falls, I said, look, you need to get out quickly because the sentiment is strong. That is why when you fall, you're not falling anywhere because there isn't enough short side sentiment. There isn't enough short side power to pull the market down. So that's why you're coming up at the moment. That's why the candle you can see right now in your 4 hour is just slamming into your previous high. Now, when this happens, it becomes slightly more likely, or it looks like you're going to run through this high. Because if you were experiencing rejection, you would see some form of reaction from this candle. You would see it start to teeter, you would see a candle wick, and the market would tell you, people are saying, okay, well, this is as high as we want to go. But that's not the case. And you need to be able to read those early signs to judge a better short. You can see that there. Now, I had an Academy member ask me about gold specifically. He shorted, he might be watching this, he shorted about 1972, perhaps. And I said to him, look, you've come under 1972, I would lock in gains. That way, you're either going to make a small amount, or you're going to lose nothing, or you're going to lock in a small amount. Okay, in other words, you're making an artificial stop loss because you're aware that the market sentiment is strong, and I would just reshort above the previous high. Because if the market sentiment's strong and there's no selling power, there's a fair chance you may come over the previous high. That doesn't mean I want to buy it, that just means I want to hold off to get short. And that's exactly what's happening now. That is a tactic I employ in my own trading because I know that if people were shorting, if people were making renewed shorts into the market, you would see it. You would see it by now, but you're not seeing that. Okay? People have rushed in to buy the mini dip, hence why the price is rising, but it's completely sentiment based. It's because people have got fear in the markets now. So that leads me to talk about really where I would like to short it in that case. Where would I want to do that? Well, if I think it's going to beat the previous high and I'm not a buyer, I'm just holding off so I can get the best possible short, I may indeed hold off until these previous highs. I might say, you know what, I'm not interested in rushing into this. And you shouldn't get caught in the big trap of having to trade gold. If you feel like you've got to trade gold, you're not diversifying your portfolio at all. So there's going to be times where you're forced into making a trade because you feel like you should be making money. Okay, and it's really dangerous because you'll make worse decisions. Um, so you need to be comfortable with the fact that I'm not going to enter until I get up here. I'm going to trade something else. Okay, there's all this stuff you can trade. It's all here on the screen. So that's what I would do. Otherwise, I would just hold off until these previous highs. And even when you get to the previous highs, and you know this is factually a high price because it's the highest it's ever been, okay, therefore it's a high price. There's no denying that. Um, everything is based off the previous data you can see. Okay, the only argument you can make in trading is based on what everyone can physically see on the screen because it's the only data of this asset. We don't know if it's going to get higher, but we're aware that it could, like it has consistently forever. It's always gone higher gold. Um, so that's why I wouldn't be shocked if you get above these highs. But when you get above them, you'll probably have a pullback eventually, and that's when you get your chance to work your way out the market via hedging methods, etc., which is how I trade. Um, so if you need to reduce your size because your exposure is too high, I would do it. If you need to make a lighter entry because your exposure, like I said, your drawdown or the amount of money you're wrong as the market goes up, I would do that. But the general rule and the consistency throughout trading gold as a whole is the fact that your risk needs to reduce significantly. You need to drop your risk now because you're trading a market where you're slamming back into those highs, and you've seen for 50, 60, 70, 80 years that gold has gone up. Okay, so you know at some point the probability is that it may go higher than the previous high. The acceleration of gold has been very quick, and I expect once all this is over, it will get absolutely slammed back down to $1,400 or something like that, much nearer your yearly 20 MA. I think your yearly 20 MA will creep up and it will just come way, 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 way down. I think it will take a few years, maybe 5 to 10 years, or 3 to 10 years, I would say, after all these problems are away, everything's sorted out, hopefully, geopolitically, economy-wise, people will just pull their money out of gold because they're not worried about anything anymore. They don't have the sentiment to be buying it. At the moment, they do have the sentiment to be buying it. So the market is just changeable on every single point based on that sentiment at the time. Okay, so it's really interesting, and really, really something you have to follow. You've got to track that market sentiment because if you don't, you will naturally find that you don't know what's going on and you don't know why the market is moving a certain way. And probably most importantly, you will not change your risk based on what is happening. Okay, when something that could cause market risk is occurring, you really need to make sure that you're reacting to it actively. Okay, so you have to do something about the fact that risk is getting higher in the market, and it could cause you potential risk. You've got to do that. Doesn't matter what asset it is. Doesn't matter whether it's gold or any kind of index like the US 100 or the Dow Jones we looked at, the US 30. Doesn't matter what it is. You've got to adjust that risk. So thanks for watching, guys. I hope that helps as always. Don't forget to like this stream or like on YouTube, comment, subscribe, get the free training underneath. It's right there. And I will see you soon in the next one. See you there.